it's a good-looking screen, isn't it? Let's just hope it lasts.
Yes.
It lasts, right? As I was saying, I mean, people, I mean, naturally, with the amount of volatility we've had, it makes sense to watch the market for a little while and then kind of try to get in. The reversal, the absolute, not absolute, but the reversal level for me is still about 100 points away, 17,220. We're at about 17,120 right now. So let's see, 140, 130 points higher. That's the market at this point for you. More stocks in just a bit from now. But Rahul Arora is with us, Chief Executive Officer of Nirmal Bang Institutional Equities. Rahul, great to have you with us here. Thank you very much. It's been a week which feels like a lifetime. It's those kind of markets, right? What are you making of things right now?
Morning, Prashant. Thanks for having me. I guess that's what they say in the market. It's a week is a lifetime. But I think there are two or three things, Prashant. One is, of course, what you were discussing about SVB and what's happening with the US banking system. I think, interestingly, the ECB hiked by 50 basis points yesterday. And Switzerland is considered to be a very integral part of the European Union. That, as a pretext, I think the Fed may still go ahead with a rate hike when they meet next week. So our base case is at least 25. I think if you looked at the last inflation print in the US, it was at 6%. And overnight, if you took a look at the housing start numbers, they've grown by 10% and the building permits are up by 14. This is concerning because 55% of the US inflation is housing. So you can kill demand as opposed to India, which the only reason you're hiking rates is to counter the carry trade because 55% of your inflation is fruits and vegetables, which is a supply side issue. So my sense is it's going to be a challenging year. I think the very broad range is probably going to be 16 to 18,000, but with a downward bias. So keep eyes on the global scenario. But I think probably another 50 at best from the Fed and maybe another 25 from the RBI and we're done. The bigger story is going to be the economic impact of these rising interest rates. And what we've seen in the US in the last 1 week may just be the beginning of that slowdown / recession that we've been talking about. So I think when we were talking around Diwali, we were expecting the first half to be bad and the second half to be good. That was a general consensus, even from global broking houses. I think that trade is sort of reversed. I think the first half is seemingly okay, but I think it's going to get a little more challenging as we go along. So I think cautiously optimistic, as Infosys always says after its results, but I think with a slightly lower bias is my sense.
Okay, so it's interesting that you're going back to that cliche that we love and hate with equal vigor, right? Cautiously optimistic. But Rahul, now what you said sort of for a minute made me feel that that translates into 16,800. October lows pretty much holding for this market. But then you suddenly moved on to say that watch out for the second half. So what's the market prognosis given this entire context? And what are you advising? Should people be putting in money right now, wait, keep some cash because you get much better levels?
So, Surabhi, nobody really buys the market. You always buy stocks, right? So that 5-digit number is purely an academic number because there will be stocks that are 7,000-8,000 Nifty also that are expensive, and there will be stocks that are 18,000 Nifty also that will be cheap. There is value that's definitely emerged, and if the Nifty was to grind lower, see, when the Nifty started grinding lower, it's changing its range by 500 points every now and then, right? It started off with a broad range of 17.5 to 18.5, then that became 17 to 18. It's now 16.5 to 17.5. So it's progressively grinding a bit lower, and that's a bit disconcerting. From an economic standpoint, I think we're at about a 6% GDP growth with a slightly, lower bias, so to speak, for next year. But I think if you've read the data points on DLF overnight, they've sold about, apartments worth $1 billion in 3 days. So I think the K-shaped recovery that people are talking about is today more pronounced than ever, I think, because everyone is moving their portfolios away from mass to premium, right? Whether it's two-wheelers or whether it's consumer discretionary versus staples or so on and so forth. So I think given the fact that we're in a pre-election year, I think a lot of onus is going to lie on the government of India. The fact that Madam Finance Minister has spoken about a 33% increase in capital allocation, and a bulk of that is going to go to roads. So I think that's one sector where we be overweight. Stocks like PNC, Infra, KNR, Construction. As a second order beneficiary, I think cement will do well.
Right.
I think we're looking at an 8-10% kind of volume growth. And I think as a tertiary benefit, if you have a good monsoon also, which generates employment, I think consumption could probably make a comeback. So I think that's probably one bucket at play. And maybe commercial vehicles and chemicals. I think this is where the sectoral allocation would be if I was making a portfolio today.
Well, Rahul, you've been tracking the consumption space for a very long time, and you said that a tertiary benefit could come to the consumption names. Just wanted to understand your thoughts, how you position on that space right now, in light of the big management changes that have happened. Colgate has Prabha, then you have Sudhir Sitapati at Godrej Consumer, and recently the announcement coming in from the big boy HUL.
So I think these are well-oiled machines.
Yeah.
I think, unless you have someone that really comes and messes things up, and these are homebred names, right? And you could extend that to an HDFC Bank or a TCS or an Infosys or whatever. I think these are such well-oiled machines where I think unless something goes dramatically wrong, I think the growth will continue. I think the macros will probably dictate. I think from an allocation perspective, I think most FMCG companies in India have broadly 35 to 55% of their sales coming in from rural. I think that's where the incremental delta is going to come from because, if you analyze Lever over the last decade, it's compounded its top line by only about 8.5%. It's because the margins went from 15 to 25% and your earnings compounded by 17, 18%, that the stock went from 300 to 3,000. Do I see that visibility for the next decade? It's very tough to get a 10% margin expansion on these. So you need volume growth to come back. My hunch right now would still be a little bit more on consumer discretionary than it would be to consumer staples. But like I was telling Surbi, I think if you do have a good monsoon and these projects do get announced and it results in employment, my tilt would probably still be towards Lever and Britannia. I think those would be the top two staples I'd play. And from the discretionary side, I'll play something like an Indian Hotels, which is a leader in its pack, maybe a Westlife in the QSR space. Yeah, I think more than that would be too much of consumption at this point, but that's probably how I would structure.
But you're positive back again on Indian Hotels because you said...
No, so I think this is going to be a good year. I think beyond this year is going to be a challenge. You're moving into an IPL in a couple of weeks. On the other side of the monsoon, you have the Cricket World Cup here. So I think this year should be okay. But to give an exit multiple is going to be tough because at 350, 400, Indian Hotels goes to about 25 times EV/EBITDA. I would probably buy a Westlife today as opposed to an Indian Hotels. But I think Indian Hotels for the next 1 year, Westlife, I think, is probably a more compounding story over 5 years. I think this stock could potentially double from here, is my sense.
You've been a big bull on Westlife for as long as I can remember. Yes, Rahul, we know that. Just to follow up on consumption, and Mangalam and I were discussing this on our digital show yesterday because we're trying to piece things together. Yesterday, Maruti comes and tells us that purchasing power is getting hit because of higher inflation, cost of ownership, and so on and so forth. So they are seeing a visible reduction in inquiries, the rush to go out and book. That's a statement from Maruti. So when we're talking discretionary, on the other side, you are seeing what you're seeing with DLF. Now that's premium end, obviously. How do we put the pieces of the puzzle together to figure out what part of consumer is the safest to play in an environment where things will get challenging, but the second half, as you say, could be perhaps worse off than the first?
I think this holds true across the board, Surbi. I think if you extend it into two-wheelers, I think Eicher is doing better than TVS, Bajaj and Hero at this point in time, and so on and so forth. So I think, okay, so let me put it this way, right? So you probably had a period of about 15 months where people sat at home, give or take. And you probably saved a certain amount of money in that 15 months, whether you saved 3 lakhs, 5 lakhs, 10 lakhs, whatever.
So you had the revenge purchase, travel,
yes,
all of
and
that.
I still don't believe we've seen all of it yet, right? It could have resulted in staycations within your own city. It could have resulted in, inter-India travel, intra-India travel, overseas. Anything could have happened. I still think that there is still that amount of money that's still there to be deployed, but I think that wealth effect at some point will wane. So, which is what I was telling Mangalam earlier. I think I would still be positioned heavily on any segment that is offering you premium, regardless of the sector. I think on a lighter note, even something like a cement, if you hear their conference calls, even they talk about premium cement and the kind of, sales that they're seeing. So I think that the P word, so to speak, is gaining a lot more traction than the M word, which is the mass word. I'll give you a case in point. We, met the management of V-Mart Retail somewhere in December. They I think they have about 70% of their stores in UP, Bihar and Jharkhand. Very few companies will give you a pulse of the rural market like V-Mart Retail would. Bang in the middle of winter, a company that's situated in Delhi and does its sales in these markets, volumes were down 30%. You were in the middle of wedding season, you were in the midst of winter. So this is probably going to take a while to reverse itself. And that's why people, you'll find most managements. I mean, just to go back to a point on Lever, right? The last analyst meet they had, Sanjeev spent a lot of time talking about the fact that 1/3 of Lever sales are now through premium. And Lever would never historically talk about that because they want to be seen as a mass market brand. So I think that's changing, and I think your portfolios need to align themselves to that effect.
So 7 crore houses and,
but I wanted to say that...
2 crore cars.
But the 7 crore, I mean, sure, I mean, the top end is doing very well, but that's also to do with the budget, tax changes, etc., right? I mean, a bulk of it would be driven by that. So I'm not sure how much of that one should read across as, the top end also doing so phenomenally well. I mean, it's been doing well, absolutely.
No, I take your point, but I think if you just go back and annualize the sales that people have been doing, let's take the Bangalore market, since you guys were discussing IT. Look at the sales that Brigade, Shobha and Prestige have been doing at the premium end. And I think this is across the board. I think Oberoi, I really don't think somebody from the Bajaj family has gone and bought a 250 crore three-story house just because he's got a tax cut. So I think there is demand. That's obviously an aberration.
Yeah.
But I think even prior to that, the point I was making on iShares, I think the sales have been consistently good quarter after quarter. So I take your point that this could be an added lever, but I think there is still that wealth effect that's playing itself out that will probably keep the volume growth sustained for a slightly more protracted period of time, is my sense.
Okay, Rahul, thanks very much. Great to speak with you. Appreciate you joining in with that perspective.
Thanks
indeed.
Thank you.
Well, the market is holding on with about 135 odd point sort of pop. We're at about 17,122. Holding on, so far so good. Our next guest is someone who's seen global markets very closely for a long period of time. Dan Feynman is co-head of equity strategy Asia Pacific at Credit Suisse, and he's joining us right now. Dan, great to have you with us here. Thank you very much for your time.